Hello, everyone. Welcome to the weekly roundup. Today we will cover yields, GDP, and earnings releases. Hello, Ben.
Hi, Eva.
How's it going?
Going great. I wish it would stop snowing, otherwise, it's
Oh,
going great.
I know. We're just enjoying the nice weather all week, and then the snow pops out again.
Yeah, not quite there.
Yeah, a couple more weeks though.
Yep, for sure.
Okay, we'll be kicking things off with yields.
hmm
Are we seeing an inverted yield curve? And does this speak to recessionary concerns? Please
hmm
break this down for us.
Well, we've been in and out of inversion for multiple years now, and honestly, if we go back to, the past 30 years, every time we inverted, we had a recession. And then about 4 years ago, we had an inversion and we had a recession, but the leaders of the world decided not to call it a recession. So it was a technical recession because we had two negative GDP quarters, but the market didn't seem to care. So I think we look at it, and just for clarification purposes, and obviously you and I know this, but this means that the short end rates are higher than the longer end rates, and so you have that inversion. And so that typically isn't great for the banking sector because they like to have some of the short money and then they lend long. So they borrow short and lend long, and there's the pickup. It helps with their earnings. So it typically isn't a great signal when we have this inversion. So for the most part, we're pretty flat, though. If we look at the front end, like T-bills in Canada around 2.8 and the 5 years at 2.7. So we're pretty flat. And if you strip that even out to 10 years, you're at 2.8. So pretty flat. And then in the US, you're looking at 424 on the T-bills, and the 2 years 4 and the 10 years 429. So very flat curve. So from my perspective, I'm not overly concerned about it at this present time. So there's been this thinking. I know we follow a bunch of different people, but Macro Alpha is one of the more interesting macro researchers that we follow on Twitter. Is quite good from a perspective of trying to understand what it means. And so, what he said is that when we start to steepen again, that's maybe more of a risk that we could potentially have a recession. I'm not saying that we do, and actually don't think that we do this year. But so we'd be watching if that long end started to take off to the upside and the front end came down aggressively. That would be something more to watch for some risk to the financial conditions.
Okay. President Trump is considering giving a certain percentage of the Dodge savings to Americans.
Hmm.
Could this have a potential impact on both growth and inflation?
Yeah, for sure. So, I mean, I think it's something that he said he was going to do prior, and I'm actually a bit shocked that he might actually have the ability to do that. He did say, and I'm not sure how current the information is, but it did seem to indicate that $4,500 he would give back for each individual, and that's a significant amount of money.
Yeah.
And that's something like 25% of their savings that they would get from the cuts that they've made so far. But that much for every individual in the US would really spur consumption. And so, the US GDP is 70-ish% consumption based. So if you give that much money to people, they're going to spend it. So yes, definitely, I think that would help GDP. And what would it do to inflation? It's a great question. Think that we're definitely heading towards a little bit more where inflation continues to slow. Yes, we've seen some slight upticks both in Canada and the US, which we talked about last week. But generally, I don't think we see things run away on us with inflation running super hot. But yeah, it may have an uptick for inflation, but definitely would help GDP in the US.
Okay. German elections. Could this new leadership help the economy? Anything worth noting here?
I think it could. I think what most of the countries, Germany and France, well, those two particularly, need is some commitment to work together and get the economy going. Germany is such a manufacturing-based economy, so they do need the euro to continue to be weak, and so ECB continues to cut rates. So I think maybe a combination of new leadership and rates continuing to come down, that could be a good thing for the German economy, and a good thing for Europe as a whole. So I'd say generally positive.
Okay. And on the market front, a couple of earnings releases this week.
Mhm.
Anything interesting to share?
Well, NVIDIA's, I think, was probably the most watched this week, and that came out last night after the close. It was good. It was good. I mean, they've been in a sideways pattern. At least the stock's been that way for most of this year. And the earnings came in quite good. If you watched or listened or read the reports, it seems to be that they're moving in the right direction. The chips are getting faster, but they need to get faster in order to keep up with the speed at which AI is accelerating. Stock hasn't really been happy today. Opened up, down, touched down maybe 5%. Now it's down 3.5%. So it seems to be moving off the lows. So the market's been a little bit jittery off of it. But if you read the research, there were some revisions to higher target prices in a lot of cases. And so I'd say a general positive because the stock's been a little bit sideways and there wasn't a big move either way out of this. So generally positive from that. But yeah, lots of earnings this week for sure. That was the biggest though.
Before we go into the charts, anything else catch your eye in the news?
Well, I know we spoke about Macron and Trump in their meeting yesterday, you and I offline anyways, and that was interesting. Because not many people have corrected to President Trump in live TV. And so that was a worthwhile event and also a worthwhile fact-checking clarification perspective that Macron brought. You know, their country and economy is in a difficult spot as well. I've always thought that he was a really strong leader in Europe, and I think that was a good signal that they're not going to be pushed around physically, actually. But if you haven't watched that event, it's worth watching. 30 seconds of your time.
Agreed. Let's go into the charts.
All right, sounds good. All right, we are, yes, recording this on Thursday, February 27th, and around 1 o'clock. So anything that happens after this, certainly we won't touch on, but we'll cover next week. And to your point, Eva, just about where we are today and what's going on with earnings. Always good to look at this. We get this updated on a weekly basis just to give us a sense to where we are. So on the left-hand side will be the S&P 500, which is the U.S. companies. On the right side here is the TSX. And so on the left side, you'll see 86% reported already and 76% beat. 8% met and 17% missed. And so that's interesting, worthwhile, certainly still a lot on the beat side of things. I'm not sure how the financials got to 101% reported, but that's an interesting metric. But always worthwhile to look at who's meeting, who's missing, who's beating. Oftentimes I look at the misses and say, okay, well, is there any opportunities in that space? And the beats, if you saw some big rallies, that would certainly be worthwhile to pay attention to as well. I'd say the one note, at least in Canada, you would see communication sector 80% reported, 100% beat. That makes a lot of sense because the telecoms last year, Rogers, BC, TELUS, they all had a tough year in the market. They revised earnings down, and now they're starting to come either in line or beat in this case. So I thought that that's worthwhile, interesting, and those stocks still have good dividends and are attractive from a timing perspective too. The other thing which we comment on quite often is the US CAD and the US dollar. And so there's the general thinking that all of these tariffs and all the things that President Trump is doing will cause a super strong dollar. And I think that's what we had up until a couple of weeks ago when we had the tariffs were going to kick into place. And so we saw the Canadian US, we saw the US CAD actually. So US rally up to, I think we mentioned a couple times, but 148 or 67, 68 on the other side of things. Now we've seen a pretty material correction into that. We're down to the 142, 143 levels. And same on the DXY. So the DXY would be the US dollar versus the major crosses. Canada is part of that, but Euro, GBP, Japan. So you've seen a weakening US dollar, which is interesting and I think worthwhile paying attention to, because a lot of the international countries pay and borrow in US dollars. And so a weakening dollar is a positive for their economies. So there's been quite a bit of attention towards the provincial governments working together, pushing ahead. Let's see how we get Canada rolling in the right direction. This was a noteworthy piece came out from our sustainable team in Toronto or Montreal, excuse me. And it's a great look at what's happening and what these provinces are trying to do to get the Canadian economy prepared for in the event that we get into a difficult spot. So BC, British Columbia, fast tracked the list of mines, LNG, which is natural gas pipelines and energy transmissions. So this was something that would have taken another 6, 18, 24 months to push through. But you've seen some of these positive things moved forward and put in place. Some different projects and the most relevant companies that are going to be impacted from it. But these are great to look at. Pipeline power lines, excellent. Connector pipeline, Brookfield Keyera. This other one, Pembina LNG natural gas export facility. This is great stuff. And so while there's lots of worry with Canada-US relations, we're actually seeing some bright lights from perspective that some of the Canadian provinces are saying, okay, let's get going, let's move forward so that we're prepared in the event that we continue to have trouble with the US-Canada relations. So I thought this was a great chart of some of the companies that have moved ahead with the view of issues with U.S.-Canada relations. And the last one, just before we jump into our final thoughts, is we are approaching the end of RSP season, which is Monday. So just a quick reminder here, if you haven't contributed to your RSP, the limit for this year is 32,490 or 18% of your previous year's earned income. Obviously, RSPs accumulate, so you could also have accumulated room. Best place to check that is on the CRA online site. You can go and check, see how much your RSP contribution room. But if you haven't done your RSP contribution and want to, certainly please let us know in the next couple of days as we start to reach the end of that. Since we're on this, just the TFSA and the first-time home savings account as well. Tax-free savings account this year will be again 7,000. So if you have never contributed to your TFSA, you could actually put in 102,000 at this point. But for this year, it'd be 7,000. And then the first-time home savings account, we are into year 3 on this one. And so this is 8,000 again for the 3rd year. So you can contribute to your first-time home savings account anytime in the calendar year. But just most importantly, that we're at RSP time. So as we wrap to the end of that, if you're interested and haven't done so, certainly reach out to us or to your advisor and proceed to make your RSP contribution before the deadline. Let us comment just before we jump on the other one. This is not necessarily the opinions of National Bank Financial. If you have any questions, comments, either talk to us or speak with your financial advisor. That's it, Eva.
Great. Thank you, Ben.
Mm-hmm.
I thought you were going to say the tongue twister.
The whole thing?
FHSA.
Oh,
Got it this
yes.
time.
FHSA, yes. Worst name ever.
No. So what's on the agenda for next week?
So we are, and obviously tomorrow is the last trading day of February. So interesting to see how we wrap up that way. We start to get into our March, and rate announcements will be the focus. Bank of Canada meets on the 12th, and then the FOMC meets on the 19th. I'd say that'll be worth watching, those 2 events, certainly. The one thing that came out this week, which we haven't just mentioned on yet, is as Trump continues to move forward with his executive orders, one of our research teams that we use internally is ISI. They put out a great piece on the potential clash that the FOMC and President Trump will have because he signed an executive order that gives him potentially the ability to audit the Fed. and that could put Chairman Powell in a difficult position. They're talking about, how much room can he give from a, we'll say they kind of wear two hats, which is regulatory and monetary. And so can they give up the regulatory authority and defer to the government, but continue to have the monetary control? So I think there's going to be a real clash between them over the next, probably a couple of months. And that'll be worth watching because the Fed's always been focused on that independence from the government. And if that starts to get pulled into question, that's going to potentially have a material impact in the markets.
That is definitely something to watch out for.
For sure.
Okay, thank you, Ben. For our
Okay.
clients, please reach out to me if you have any questions or if you'd like to book a portfolio review meeting with Ben. For everyone, please visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. Just a last announcement, our daily blog will be back soon. I will send you details shortly. Have a great weekend. Thank you for listening. Bye.
Thanks, everybody. Take care.